Introducing our newest edition, the Daily Market Review. Our objective, to provide you a recap of the daily economic reports and particular points of interest within the financial markets. Today, we're going to talk about building permits, new home sales, and a growing divergence in the manufacturing industry that should be a cause of great concern. But most importantly, we're going to prep you for this week's huge economic calendar, which could prove to be a key pivot point in our economy. Starting off, building permits. Reported in thousands, the latest update reveals 1.4 million building permits, representing a decline from the prior month's 1.5 million. This does represent somewhat of a disappointment, as the building permits issued today go to create the new homes we'll see in the market in the next building cycle. Speaking of the housing market, new home sales. New home sales now report 693,000 homes sold, an increase from the prior month's 637,000. This certainly is an encouraging turn of events, even more so considering new home sales on a year-over-year basis. Increasing at an annual rate of 8.3%, this figure now stands at the highest level we've seen going back to October of last year. However, this good news may be overshadowed by the ominous growth in inventory. New home sales inventories are also rising, and quite dramatically. With 477,000 homes on the market, this figure has been steadily rising over time. On a year-over-year basis, the growth in inventories is also quite evident, now making a 10% increase compared to this time last year, not only surpassing last month's 6% figure, but also registering the third consecutive report in positive territory. To understand this thoroughly, we consider the month supply. Currently, there's an 8.3 month supply of new homes on the market. In other words, at the current pace of sales, it would take 8 months to sell all the homes currently listed. Given the average monthly supply over the past several decades stands at 6 months, the current 8+ months of inventory indicates there's quite an excess amount. But we also need to talk about the earnings season, because what may seem like an isolated story actually has ramifications on a much broader scale. Nucor Corporation, the largest steel producer, reported first quarter earnings, and their results were not good. The news certainly was a disappointment to the market, with the stock down nearly 10% for the day. But what makes this story particularly interesting is when we read between the lines. Nucor cited lower average selling prices for both its steel mills and steel products. This begs the question, given the current pace of inflation, wouldn't we logically expect higher average selling prices? But here we see the opposite. To understand this phenomenon, let's take a look at the recent Philadelphia Fed manufacturing data. In purple, the prices manufacturers pay. In blue, the prices they receive. This histogram bar shows us simply prices received minus prices paid. And this stands at the lowest level going back to August of 22. Certainly not a good trend for the profit margins in the manufacturing industry. And the results are also evident in Nucor's earnings. Why is this trend a concern? Due to rising inflation and/or worsening economic conditions, the consumer simply cannot afford as much, and the producers are starting to suffer the consequences. But the most interesting is yet to come. Here we see the Fed funds futures showing the probabilities the central bank will not cut interest rates in the June or July meeting. The odds the Feds will leave rates at current levels in the June meeting dropped 2 points in the past day, from 83 to 81%. And the odds of no change in July just fell from 58 to 53. What does this mean? It appears as though the market is preparing for the next big economic numbers on our calendar and anticipate either a decline in growth or a decline in inflation. Any divergence from this expectation could certainly surprise the market. Speaking of the economic calendar, this week's schedule definitely packs a punch. In the next few days, we're going to learn about durable goods, gross domestic product, and the ever important PCE inflation data. The results of these figures will help to determine when the Fed will finally cut rates or perhaps consider raising borrowing costs. But interest rates alone are not the only tools the Fed has in its arsenal. There are other ways a central bank can steer our economy through the storm, including the repo market. Here we dive into the details and show you exactly how the Federal Reserve uses the repo market to fight inflation and what the numbers are now telling us.